Hey, good morning, everybody. Welcome to Multifamily Unplugged Saturday morning. Here's all I can say about today is buckle up. That's my new expression, buckle up. And for this one, you're going to want to go make sure that somebody else is around, paying attention to this, because my guest today is going to explore some places that, almost the unspoken word in what we do. So I want to make sure that everybody is here, present, and paying attention today. So if you're new to the program, welcome. Glad that you're here today. Go tell somebody else. You are not going to want to miss today's show. Hey, but before we get started, as I always start my show every week, is I want to see what you're being intentional about. You know, our intentionality in everything that we do is so important. You got to have your mindset right. You know, you have to be able to say, you know, if you are out there raising private capital and you're looking for investors or you're building relationships with brokers, be intentional about it. Know before you pick up the phone and make that phone call that that's what your end result is that you're looking for. Hey, if you're knocking on a seller's door and you're looking to purchase a property, know what your end result is. We have to all be intentional. And I say this, with all sincerity today, because I think that as we walk in this multifamily space, that our intentionality is really important to rise above and to walk a walk of integrity, ethically do the right thing always. And we're going to talk about that today. Hey, please, if you are new to the show or you've been here a while, please like us, love us, follow us on Instagram, on Facebook, Twitter, wherever you get your social media fix. Just please follow us. If you're on YouTube, welcome and subscribe so that you always see the relevant content that we put out and the knowledge and information that we provide. So I'm glad that you're here. Also, remember, this show is sponsored by My Core Intentions. My Core Intentions is a coaching and training company that we bring help and support to the multifamily investor trying to live a more balanced lifestyle. So I'm really glad that you're here. And however I can deliver that information to you, I love to do that. All right, let me tell you a little bit about my guest this morning. Like I said, buckle up. This guy's amazing. I've known him for a number of years. We've developed a deep friendship over the years, and I have a lot of respect for him, for his story, and for what he's accomplished. James Brandolino, he goes by Jimmy. He's said, Mike, listen, on the show, you feel free to call me Jimmy, okay? Because we're longtime friends. But his name is James, and I have to be respectful of him and that this morning. But James is the investment fraud guy. And we're going to talk about investment fraud this morning. You know what? You guys know my history, you know my background, and we're going to talk about, how to stay ethically and morally right in what we're doing. But let me read this to you because I think that this is fascinating. Thousands of investors continue to lose billions of dollars each year to investment fraud. New Ponzi schemes and security fraud cases are reported regularly in mainstream media. Investment fraud is not only problematic in the U.S., but it's a global pandemic. Now, you think we just went through a pandemic? I think we're going to talk a little bit more this morning about some other pandemics. Let me bring Jimmy in. Hey, pal, how are you?
Morning, Michael. How are you?
I'm great, man. I am so glad that you're here this morning.
This is awesome.
It has been a long time. We've been talking about this and trying to figure out a date, and we missed a date. And, I really have been looking forward to this episode, and I've been looking forward to it because I think it's a message that the listeners need to hear. And I'm going to just, here's what I want to say. Anybody listening, if you have a comment, if you have a thought, throw it in the comment section. We'll get those questions answered for you. If you are somebody who really wants more information, make sure you connect with Jim or me, Jimmy or me, and we'll get those questions answered for you. But I want you to know that what we're going to talk about today is a serious matter. I think that there's a lot of this that goes on, a lot of fraud that goes on, and we're going to really dig in and roll up. So buckle up, everybody. Hey, James. So one of the first questions I always ask my guest as I kick off the show, and I'm going to write a book one of these days with all the first words that everybody has said, but what one word best describes you personally and professionally?
Already with the trick questions. We're only 45 seconds into the podcast. Wow. One word. I would say resilient. I think that it takes a lot of resilience to kind of, come from at least my background, where I came from, and what I did, and kind of the journey that I took, and basically be the poster child for investment fraud. This is what I did. This is how I did it. And, this is what you should watch out for, so you don't become a victim of fraud. And it's not always an easy path. But I think for the most part that I'm doing good work, and that's what I want to do.
I know you're doing good work because I've, been listening in on you and following you for a while. So, couple things. Resilient. If you read my bio, I say that I'm resilient in my bio. I've fallen, I've been victim, I've had my challenges, but I'm resilient. I've bounced back, and that's my hashtag bounce back, right? So, but I really think people need to be aware, and I really believe that this episode, people need to listen to this, pay attention, download this episode, share it with somebody else. You know what? I got visions and a goal of this thing to go viral. So let's get into it. Why don't you start the first couple minutes, talk about your background, your history, and how you got to where you're at today.
Okay. Well, ever since I was a young kid, I wanted to manage money, right? I wanted to trade. And probably the big impetus for that was in 1983 when the movie Trading Places came out, especially at the end of that movie where Eddie Murphy and Dan Aykroyd corner the orange juice market at the New York Board of Trade. And, being in Chicago, we had three major exchanges, the Board of Trade, the Options Exchange, and the Chicago Mercantile Exchange. That was just, it really kind of stuck with me. I went to the University of Illinois at Chicago. I got a finance degree, worked at the Board of Trade as a runner for a number of years, was in the finance industry with Charles Schwab, and worked at a major trading firm, MF Global. And it got to the point where, after being a broker for a number of years, that I wanted to go out and trade. So I trade other people's money instead of just, being a broker. And the big reason for that is, as a hedge fund manager, you could not only, charge, a 2%, annual fee, but you could charge 20% of profits. So that was just a huge inducement to be a hedge fund manager. So in 1999, I left the big firm MF Global, and I went and became a member of the Board of Trade and did all my documents. And within the first couple weeks of managing customer money, client money, which were family, friends of family, and longstanding clients, I started to lose money. And I'm like, boy, what am I going to do? Right. The first couple of weeks, the first month, I'm going to show a loss. Right now, we're talking about 3%, right? I've had months that I lost more than 3%, but you're on your own, you're doing your own thing. And now I have to go to my clients and tell them I'm losing money. So I guess just deathly afraid of that. I was sitting in an office of a client of mine, a colleague of mine, and we were discussing, trading and whatever we were discussing. And I picked up a copy of Institutional Investor and was just paging through it. And I see an advertisement for accounting software for hedge funds. I'm thinking to myself, wow, this is interesting, right? So I gave him a call. How does it work? Well, for a couple $1,000, I could set up, send clients, statements. Instead of having my accounting firm do it, I would do it. So that's what I did. I figured, well, 3% I could make back in a couple months. So, I fired my accounting firm and sent statements out, and of course, minus 3%, minus 5%, minus 10%, all the way through. So after about a year and change, when the money that I was trading was dwindling down, instead of going out and raising additional money from them, I decided to put my own money in. So, I sold my condo, downsized, went into my 401k, and that lasted for about a year and a half or so. And basically, brought that down to my net worth down to about zero. So now we're almost three years out. And of course, clients know nothing of what's going on. I haven't, gone to them and told them what I was doing, that we were losing money. And at that point, even though I had committed fraud, it was civil at that point, right? Because I hadn't physically stolen any money. I was falsifying returns, showing gains versus, in actuality, they were losses. But I didn't steal any money. And then the time came, just magically, I had a client come in and, drop a $500,000 check on my desk. And it's like, well, boy, this is the chance I could make it back now. So, but before I could do that, of course, I had to siphon a little bit for business expenses, a little bit for personal expenses. And that, unfortunately, that trend continued for 8 years, for 5 more years after that, for a total of 8 years. And we're looking at the end of, 2010. And, there was never really a time in my fraud where I didn't think that I could make the money back. I mean, I had traded profitably, very profitably for a long time. And I always thought I could make it back, but just couldn't. And one day I'm sitting on my balcony, overlooking downtown Chicago. And I'm like, you know what? There's no way I'm not making it back. I'm done. So after a period of let's just say severe mental anguish, I went, I found an attorney and basically walked into the U.S. Attorney's office with the FBI present and said, this is who I am. This is what I did. And I'm turning myself in. And very quickly I was indicted and served 6.5 years in federal prison and have been out since 2017. And I basically speak and consult about my story, about, what I did, how I did it, how basically everyone missed all of the key red flags in my case, and talk about other cases, and work with law enforcement, speak with law enforcement, talk about ethics and the whole realm.
So I have a couple questions.
Sure.
Boy, there's a lot there to unpack. And hey, listen, shocker alert, right? So
well, you have carte blanche to ask me whatever you like.
Yeah, thanks. But shocker alert for anybody listening in going, holy shit, right? Here we are. And I don't think I ever swore on this show. So there you have it. So first I want to know, was it operator error or was it market driven?
Well, probably 98% operator error. So my big issue, so I traded as a broker before I went on my own. I had a bond trading system, right? That traded bond and bond futures. And when I went to the trading floor, even though I'd worked on the trading floor on and off for a number of years and knew my way around it, there was no space for my desk near the bond pit. So my desk was actually right across from the S&P, from the Dow Jones futures. And as I'm setting my desk up and getting the computer system set up in there before I started trading client funds, I'm thinking to myself, boy, all of the institutional orders that are coming into the pit, boy, all this extra wild volatility. If I could just modify my trading models just a little bit, instead of making 5%, 5.5%, which my clients had no problem with, right? Because of the non-correlated, pattern of returns with my system, boy, I could jack that up to 9, 10, 11%. I could be a hero, right? And that was my first issue. So I took a week and a half, 2 weeks. I did some real basic testing of my model, and it quasi worked, but I could figure it out. There's so much profit potential that I'm not taking advantage of, and that was my fault. I basically was trading a market that I really knew nothing about in terms of the risk reward characteristics and the volatility, et cetera, because it trades completely different than the bond market and trading that yield curve, which what I was used to doing.
So, I'm in the real estate space, and we raise private equity for multifamily deals, and people, so we package apartment complexes,
Sure.
and we go to the market and we raise capital. And now
Sure.
I'm not the only one in the world that does that. There's a number of companies, there's a number of groups and teams of men and women around the country that do this. It's a common business model. How does just the ordinary everyday W-2 employee who is looking for an alternative investment against the stock market, that they see real estate as one of those places that they can be, and they don't want to deal with tenants, trash, or toilets, but they want somebody else who's running it and operating it. How does the current everyday person, be assured or know that the person that they're going into business with isn't going to do some fraud or it's not some Ponzi scheme?
Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
So my message goes out to both operators and investors, right? And even though my niche specialty are hedge funds and trading, the product doesn't really matter whether you're doing multifamily, whether you're doing crypto, currency, precious metal trading, baseball cards. It doesn't really matter. I mean, a Ponzi scheme and fraud the signs are universal, right? Yeah, of course, there are certain nuances between products, but probably the biggest issue that I see, and in the last probably 6 months, I've gotten more real estate type of projects, whether being referred from attorneys or CPAs or help with law enforcement than I have ever. And I would say the big commonality, the biggest issue is how operators raise money, because there's only a certain number of ways, right? You're going to do a Reg D exemption. You can do a 504, a 506B or C. You're going to do maybe an interstate 179, 179A. Maybe you do a big Reg A. But the biggest, probably the biggest, most popular way to raise funds is getting a Reg 506B exemption, which basically operators can raise as much money as they want with as many investors as they want, and not have up to 35 potential unaccredited, non-accredited investors. And I would think the biggest issue, number one, is making sure that your operator, asking him what type of registration that he has. Is not just a limited partnership if he's going out and raising money. And probably even a better question to ask is, if you're an investor, there are certain rules and regulations specifically stated by the SEC that operators have to follow. And whether you're an accredited and sophisticated investor or a non-accredited investor, operators have to follow certain rules and regs, and you want to make sure that they're following those. One of the big things that I see, offering documents, or what we would call a PPM, a private placement memorandum, is not required in a lot of those registrations unless there's non-accredited investors involved. And that just amazes me, because the offering documents are basically that quasi legal and business document that protect the operators and protect the investors, right? And I've seen documents that are probably 50 pages plus with a lot of legalese, and I've seen some that are 3 pages, 4 pages that really don't protect anybody. And that's probably one of the first signs, looking at the private placement memorandum, that document, and looking to going through that and just kind of seeing what is the operator doing, what is his what expectations is he setting, but also what lane is he gonna follow, and basically the 500 risk the risk probabilities of certain things happening. Because look, there's nothing wrong with an operator losing money as long as it's lost legally, right? If an operator is following his disclosure document, his prospectus, right, and he's in his lane, and something happens, right, that's disclosed in the risk section, and investors lose money. Okay, I mean, we lost money. It is what it is, right? However, if an operator says that he's going to buy nothing less than a 20 unit, and he loses a ton of money on 6 units, and investors or someone like me see that they didn't follow their plan. Now, there's no fraud involved, but they didn't follow the plan. Then there's definitely some civil repercussions that could definitely take place.
So just a document, though, doesn't, just because it's written out and an operator has to look at that and say, oh, I'm not going to commit fraud, doesn't keep an operator from committing fraud, especially if things in the market happen and, the market shifts. Is there anything like unintentional fraud ever? I mean, like some people maybe don't have to directly do something, but they get caught up in a market shift or turnaround. How does that get looked at?
So, my thing is that investment fraud is different than other types of fraud, credit card fraud, healthcare fraud, et cetera, because investment fraud usually does not begin as fraud, right? There are very few individuals who wake up, and I'm going to say probably it's maybe 10% of all cases, maybe a little bit more. They wake up one day, man, I want to steal $20 million. So I'm going to go, get a website, go and snatch a disclosure document from the internet, change it up a little bit, rent an office, get a phone number and go out and solicit money and send that money as soon as it comes in to the Caymans. And when I get that knock on the door or that phone call from the SEC or some regulatory agency, I'm on a private jet, out of the United States. I mean, it happens, but it doesn't happen very, very often. I mean, most people, want to be successful as business people, not, known as being bright and running a successful business instead of being fraudsters, right? So because of that, when something goes wrong, the interest rates go higher, values go lower, the stock market goes the wrong way. If they're selling a product, maybe they don't get a sales contract or something happens. And what makes investment fraud different is that the perpetrators of fraud, myself definitely included in that, are that, we're not looking to steal money. We're looking to buy time. We falsify documents to buy time, right? And it's not if things turn around, it's when they turn around, right? And a lot of times they don't, as in my case, as in many cases. But we look to falsify documents in order to buy time for things to turn around. And like I said, a lot of times they don't do that.
Interesting. So specifically in the real estate space, I'm not going to say just multifamily. One type of fraud that I hear that goes on right now is a fraud for leasing fees. So, there'd be and not necessarily a property manager or a licensed, professional, but you've got people that are out there, they'll scrape data from the internet, they'll post a property for lease, people, and then they'll go and say, well, if you want to see this, you first have to fill out an application, and they collect these leasing fees, right? That's a big type of fraud that goes on out there. Are there other types of frauds that specifically in the real estate space that happen that people should watch out for? Or how can people watch out for that, right? How do you vet that type of thing out?
So I probably have less experience with the example you gave. I don't do a lot of the, and I don't want to diminish it by any sense of the word. I don't do a lot of the, smaller stuff. I focus on people who are writing checks for, 50,000, 100,000, 500,000 into a fund. And then there's potential fraudulent activity that happens. I think that the biggest thing is there has to be transparency between the investor and the investment company. Now that's a little bit different than it is on, say, on hedge funds that actually trade, right? Use trading algorithms, because of course, the traders don't want to release their intellectual property, their secrets. I'm not saying that there's not intellectual property with multifamily development, et cetera, but it should be technically a lot more transparent than it is, because there's really no secrets. Okay, this is what we bought. This is what we put into it. This is what we're doing. Here's the money coming in. And, a big part of that is, and it's difficult. It's difficult for me. It's really difficult for investors sometimes to look at that document and basically it's two things. Are the principals, are they who they say they are? Number one. And number two, the document, their operating document can be 100% legit, but are they doing what they say they're doing? Wow. And how do you make sure that they're doing what they say they're doing? And, sometimes, I get, one of two clients, right? Either after a speaking gig, I've got this investment opportunity that, I've got a document for, and they're trying to get me to put a couple $100,000 into. Would you look at it? Sure. And then the other side of that, well, my brother-in-law got me into this investment about a year ago. Now everything's fine. There's no problems. But, the phone calls are being returned a little bit later than usual. And sometimes my statements come a couple weeks late. I'm not worried about it, but would you look at it for me? Right. So I think that the big thing is that transparency, in terms of if you can go to go to the management company and, ask the right questions and get the right documents to ensure that they're doing what they say they're doing. That's great. There's other times where, clients come to me and say, look, I don't want, the management company or the fund or whatever. I don't want them to know that I'm nervous. You can't contact them. I've got to go exactly from, the materials that they've given. And if they've done any, their social media, LinkedIn, any regulatory documents that they filed, et cetera, and that can make it a little bit more difficult.
So would we be safe to say that some of the red flags might be lack of phone calls from the sponsor or the operator back to the investors, late phone calls, not answering the phone? What other types of red flags might an investor notice that something different is going on?
Well, I think even more so than that, because by that time it very well could be too late. I think more so is there has to be a high level of transparency between investors and the management companies, the operators. So I'm not going to mention any names, but there is a wildly successful, and I'm going to say that again, a wildly successful multifamily workshop provider and investor who has probably a number of funds out there. And he basically put this YouTube video out that stated the following. A gentleman he knew gave him a $20 million check, right, to invest because he trusted this person. And this person, the client, actually sent an investigator, an attorney, I'm not sure who, to the office to go through books and to look at stuff. And after 4 or 5 hours, the fund operator basically told the guy to sit down and gave him the check back to give to his boss, right? I thought your boss trusted me. I don't do business with that. If he trusted me, you wouldn't have to come here and do the due diligence. Yeah. And that completely surprised me, because it actually should be the absolute complete opposite. Especially in the multifamily space. There's, there might be some secrets, and there might be some best practices that the firm does not want to kind of let out, but those usually are more on the marketing side and raising equity side than they are on buying and fixing up and how they find homes, et cetera, that, looking at the back office of an operator should not be a problem. And that's whether they, hire, a CPA firm to come in, hire a, investigator like myself, or if they have the right questions to ask to be able to, to get those documents and get their questions answered. So I would say probably this, this trust /secrecy is probably, especially in the multifamily space, is definitely huge. I think the second largest one are, and this is going to be a big problem for operators. This is maybe directed to our operators. Is, operators are looking to raise money, and they are breaking the rules, probably the majority of them unintentionally, about raising money, about advertising, about raising money from non-accredited investors the right way, right? And there are very strict guidelines in doing that. Yeah. And I think there's going to be a lot of operators that could potentially now get in trouble, and that's probably more, civil. That wouldn't be criminal necessarily. I'm not an attorney, but there's definitely a lot of potential problems that I see there.
So a couple things here, and one is, I have said no to investors before, right? Somebody wants to put $50,000 or $100,000 in a deal, and I just have felt in some cases that we weren't a match for one reason or another. And I have told investors no. I've done seminars where people pull out their checkbook and they want to write a check right then. And I go, hey, hold on. I can't take your money tonight. You need to look at documents. You need to walk away for 3 days. You need to cool off. You need, trying to follow those standard guidelines by the SEC, right?
Right.
And I know people that don't do that, right? And so it's interesting to hear you talk about this guy who returned a $20 million check. Maybe he did it out of ego. Who knows why? I always did it out of the ability that I just didn't want to work with this person, right? So that's one thing. But would you do something real quick? Could you please explain the difference between accredited and non-accredited investors?
Okay, so not accredited investors are individuals who earn $200,000 per year, or with their spouse $300,000, and will continue to do so in the future, or have a $1 million net worth excluding their primary residence. Right. So, with being an accredited investor, they're able to invest much more easily into private offerings, right, than non-accredited. And non-accredited would be anyone who doesn't meet those qualifications. So, in a lot of the filings, or the private offerings, they fall under a Reg D exemption, meaning the operators will use a Reg D exemption, so they don't have to do a full-blown offering. They can be exempt because they're only going to go after either accredited investors or only so many non-accredited investors. And what I see, well, I guess the first point of that is, I don't know why, and I was told this many years ago and didn't listen to it, but I'll say this now, I don't know why an operator would ever want to deal with a non-accredited investor, or quote, the small investor, the unsophisticated investor. It just doesn't make sense to me why they would want to do that. Why would you want to deal with so many small individuals when you can just deal with a lot bigger investors, right? But the bigger problem I see with that is, and I think how operators can stay out of trouble, depending upon the type of offering, investors are allowed to self-certify that they are accredited. So basically, the operator would send a piece of paper out, and it'll say $200,000 net worth, $1 million net worth excluding home, and then you check which one of those, and then the investor would sign it, right, and send it back. I think where the SEC is going with this, and there are offerings that if you're just marketing to accredited investors that they cannot self-certify, that you as the operator need to either go to their CPA or their fiduciary, their registered investment advisor, their attorney, whatever it may be, and have them write a letter. I mean, it could be one paragraph. I, as so-and-so's, attorney, will state that this person meets these requirements. And the investor can't just do that, because investors, they may have, $51,000 in the bank. They're going to send you a check, Mike, for $50,000, and they just, sign. Oh yeah, I'm accredited. Sure, I want this, right? Yeah. And you're probably okay, but by the self-certification is just a big problem. And I think the SEC is going to hopefully eventually change that. So they will not be able to self-certify. They'll have to be proof on that. And a lot of, look,
there's groups out there that do just that. There's small companies out there that only verify the accreditation of investors,
right?
Which is an interesting, and that's new in the last few years, right? Because of this issue, because I can't keep a potential investor from lying to me and filling out a document saying I'm accredited when they're not.
Right.
And so how do I, as an operator, protect myself from that side, right? So when we look at this fraud thing, it's not just one thing. I mean, it can happen from any area. And it does happen, right?
Sure, absolutely.
The other thing you talked about is marketing, right? So I know, and our securities attorney has worked with us really, really deeply on this, is because we put out a 506B, we can't market on social media.
Correct.
Now we can't specifically, be specific. Now, we'll do a post. Hey, this is, we're doing this, but we don't advertise returns. Where a 506C, you can market returns and things like that and put those posts out there. So, it's interesting, and you just have to walk cautiously, I think, from every aspect of it.
Yeah, you've got to get that offering document, that PPM out to investors as soon as you can, and ideally, and probably even the smarter way, and this is probably going above and beyond industry best practice, is to, when you send it to them, either in the mail or via PDF, via email, is to have an actual number on the document and match that in whether in your CRM or in an Excel file. So, prospectus number 577 went to Joe Smith in, Janesville, Wisconsin. Right. So yeah, just to be able to prove that you sent that out to them. And this is, you're keeping just meticulous records with that.
Yeah, this is really interesting because, I think a lot of times people just don't think about it, right? And
right.
People have a tendency to, hey, listen, I like, love, and trust you, and so here's my last $10,000. Now everybody's in trouble, So
that is probably one of the biggest things I talk about most. In my talks, and because we trusted you, that's why we gave you the money, and the whole thing is, whether you're, the management company is, you're going after, someone's, son or neighbor or nephew. It's like, what, I love you and I trust you, but I'm going to verify it. And, it's not easy all the time to take a 50-page document and ensure, what the management company is doing it, they're doing it, legally, and they're doing it correctly, and they're following it to the T. It's not always easy doing that.
Yeah.
But you have to do it. And I think even to go back for a second, Mike, for investors, I think investors have to, look and say, okay, how is this management company? How are they approaching me? Are they approaching me, via the internet? Did I get a cold call? Did I get an email? Was it a referral? How do they, because there's certain rules that operators, as have to follow, whether they're going after accredited or non-accredited investors.
Yeah.
And depending upon the type of offering that the management company is making. And there's definitely red flags in there that will definitely state, if there's, a potential issue going on.
Yeah. All right, let's just pause here for a minute.
Sure.
And I'm going to have her edit out the next minute or so. But I'll be right back.
Okay.
So as we start to wind this down, I would ask, can we leave the listeners with, the top three things to watch for, or to maybe make sure that they're just a little bit safer walking into a deal?
So number one, you want to gauge the operator's view on transparency and secrecy, right? How you want to gauge how well that they are going to let you in, quote unquote, and not so much to look at their books, but they are going to talk about their processes. They're going to talk about their procedures. They're going to answer whatever questions that are posed to them, right, regarding their documentation. They're going to, you want to make sure that their marketing material information is going to match what they say in their legal document, primarily their PPM, right? Their private placement memorandum. And because the marketing documents can say anything, it's the legal document is the PPM. Right. So you want to make sure that you want to get a really good feel that when you ask them questions, that you feel confident that they are going to, they're going to, let you in and answer honestly versus what you want to hear.
So when we talk about that transparency thing a little bit, a couple things that we do as a team, monthly we send out an email to all our investors, just updating them on the KPIs, those key performance indicators.
Sure.
Where the occupancy's at, the amount of applications we take, where the rent has been for the last month versus the month prior, our collections, and just really trying to give them that data, and I want to say close up look, right, where we're at in the renovations, where we're at in the unit turnovers, depending on what our business plan is and what we're doing in the deal. Plus, we also do a quarterly investor conference call. So we'll get on, we'll talk about the deal, we'll go through the numbers, and our investors know, man, if they ever want any information, if they ever want to look at the books, they can call us up, and we provide that information for them. Because I know, and in my conversations with you and from history, I know that transparency is so important. And at one level before, I thought I was transparent, but I'm even more transparent today than ever. Go ahead. What else?
Well, and you have to be, because, it protects both sides. It helps you, because you're letting everybody know where operations are at, what's going on, and, your KPIs, et cetera. And it's alleviating, any potential stress or anxiety with investors. Hey, I wonder what's going on, with my investment in this, particular, space. So it kind of works both ways. Right. And, knowing you as I know you, just, being out there and, being transparent and, answering people's questions in a relatively, fast manner, that's definitely key. Right.
Yeah. And that's the second thing I think is making sure that you're getting return phone calls fast after you make your investment, not before, but after you make it.
Yeah. Absolutely. A couple other ones I would say, you really don't want someone who's really pushy. Oh, we're going to lose this deal. If you don't write this check by, within a couple of days, we're going to lose the deal, and, we'll have to wait for the next one, and who knows how long that will be. That's probably less of a concern, because there's a lot of fraudsters out there who are not high pressure, right? Mm-hmm. Like myself, I was never, ever high pressure. I was like, this is what it is. And if you want to invest, great. If you don't, great. And, regrettably, a lot of investors said, well, okay, we're going to do it. I was never pushy. And I think that's maybe a trait that maybe is not 100% correct all the time, but I still see it a lot. There's a lot of people who are pushing to, write that check, send that wire in, wire the money in from your 401k, whatever it may be. Right. So third, in the disclosure document of the PPM, you want to see how much space is given toward risk. All the risks, anything that can go wrong. You don't want, 3 or 4 pages of risk. You probably want to see 10 pages of risk. it all kind of depends on the operation, right? I mean, I'll go as far and take that document and I'll run it. We have software that we use that will run it and see if it was actually written by an attorney or if it was just, pulled off, see how that language is written, see if it was just pulled off the internet and maybe changed a little bit to get an idea of who actually wrote that. Because, a lot of operators, when they're starting out, and I get it, right? And the same thing is with hedge funds. It costs, $10,000-$15,000 to 20,000, to do one of these, PPMs when you're trying to raise, $5-10 million bucks.
Yeah.
And it's not cheap. So of course, I remember back, in the day, back in the, early 2000s when I did my PPM, and the first one I did, I pulled off the internet and just, and made all kinds of changes, then went to my attorney and to try to save a couple $1,000 to do it. And that's fine. There's no problem with that. But you just want to you want to make sure that there is a lot of risk listed, and a lot of operators don't like to put a lot of risk there because oh my God, there's just so much risk going on. But it protects both sides. It protects investors and it protects the operators. You know what I mean? Because if something goes wrong, and something usually does, if it's pretty bad, both sides are protected.
Everything's good till something goes wrong. Hey, so that's interesting. You talk about the risk, because this is the conversation I had with our securities attorney. We're on the phone and we're going through these pages and pages. And I said to her, Megan, do we really need to have all this? She goes, yes, you do. I said, okay. I said, that's why we're paying you $25,000 for doing this. So, yes, you could just go pull those documents off the internet and doctor them. But you know what? And when we underwrite our deals, we put that legal number in there and we say, hey, this is what it's going to cost us to have an LLC and a PPM put together, that private placement memorandum.
Sure.
And, it's important. You make mistakes when you minimize the details. So,
right.
Yeah.
Something that is probably a little bit less prevalent on the multifamily space versus just, regular hedge funds that, for trading, are audited results. For hedge funds, you have to demand audited results. With a lot of multifamily, you don't see that because, you're going to spend, $10,000, to bring an auditor to come in, and, we're not talking PwC or Deloitte, right? So for an auditor to come in every year, it's going to be huge. But, there's a lot of, bigger investors that won't invest, unless there are audited results.
Yeah. And institutional investors actually require that.
Sure.
On the institutional side, they want audited financials. So, you got to make sure that your numbers work on that. Hey, listen, this has been great. Man, I just I've been captivated by, so much of what you've said. And I just want to tell people, hey, listen, this wasn't a doomsday episode. This was, just buyer beware, right? Just
absolutely.
I think everybody on all sides need to walk cautiously. Some of the, when you start to see underwriting come out on deals that they're pushing rents at 20% a year or 15% a year, or they're reducing interest rates or trying to do high leverage loans, that's where problems, that's the beginning of, in the Alcoholics Anonymous program, they say that somebody who slips doesn't just wake up one morning and say, I'm going to slip, but it started prior to that. The thinking starts to change. And that's what happens in this space also, is you start to minimize those details. And by minimizing the details, you start to try to, if something goes wrong, you start to try to cover it up. And, we just want people to be aware and walk cautiously. And, we're not saying don't invest, and especially just vet your sponsor, vet the deal, and do what you need to do to feel comfortable. So.
Well, I would say, be smart about it. There's a lot of opportunity out there, and this is definitely not fear mongering, but you have to know, the people that you're dealing with, and you have to know, you have to be able to look into their operations and making sure that they're doing what they say they're doing.
Yeah.
But I will say this, never, ever underestimate what someone will do to hide their mistakes. Right. And if an operator makes a mistake, like I made mistakes, and what I did to hide, my fraud went on for 8 years. Right. So, and it was just because I couldn't go out and tell my investors, hey, I lost money. What do you want to do? If you want to pull out, great. If you want to continue, great, right? And I just could not do that. And I think most fraudsters, a lot of investors say, well, I never would have thought that someone would have committed fraud. He would have done this to me. And I would say most fraudsters are really down to earth, good people inside. They just were afraid to come clean on something that they did wrong, or maybe the market turned or something happened they didn't anticipate, and they try to hide it and to look good. And look what happens. Millions of dollars are lost.
Well, Jimmy, let's hope that I don't lose subscribers over this episode. All right.
I hope not, other Michael.
Hey, listen, let's wind this down, take it home. 3 bonus questions. I know that you're in the Chicago market, and your most favorite restaurant.
Wow. I would say Vito and Nick's for pizza on the south side of Chicago.
Okay. When are we going?
Whenever you want.
All right. I'm ready. So how about best book you've ever read?
Wow. Overall, the best book, I would say, well, recently, I would probably say Atomic Habits.
Oh,
probably. And I believe that you pointed me in that direction. I believe so. And probably overall, though, would be The Fountainhead by Ayn Rand.
What was that about?
So basically, it's about man and his conviction to follow what he believes is his path and not deviating, not worry about what anybody else says.
Nice. And then last question, best tourist attraction, and don't say the Bean.
Well, I try to stay away from all the touristy areas because in Chicago, there's a lot of them.
I've been to some really good places though. So
yeah, I would say, I'm going to say something probably a little bit different. I would say take a trek out to Oak Park and look at all of the Frank Lloyd Wright, his home studio. And there are, I'm not going to say dozens, but there are more than a handful of homes out there that you can walk by, and they have guided tours, and they have tours where you can listen to it in a headset. And it's just phenomenal. I'm a big Frank Lloyd Wright fan. So
yeah, great stuff there. That's for sure. So, hey, thanks for being here today. How do people connect with you if they want to reach out?
They can send me an email at james@theinvestmentfryguy.com or call me at 312-684-8800. And they can connect with me on LinkedIn at James Brandolino.
Absolutely. Hey, thanks for being here. I'm going to move you back to the back room. If you hang out with me for a minute, I'm going to say goodbye to everybody.
Thank you, Michael.
You bet. Thank you. Hey, everybody. Boy, that was definitely a different episode today. And like I said, this was not about gloom and doom or buyer beware, or was buyer beware. Just walk cautiously. I think that we're going into a time where the market's going to change. We're going to be in this recessionary period. Some things that we thought might happen might not happen. And we just need to be smarter about what we do as operators, as investors coming in. I'd like to see you send this episode to somebody who maybe needs to listen to it. And if James or myself can ever answer any questions for anybody, please reach out. And I hope that this made a lot of sense for you today. If you are looking for opportunities, if you're trying to vet a deal, I'd be more than happy to answer any questions for you and, maybe help you look at something that you might not have looked at. So thanks for being here, everybody. We're here every Saturday, and I will look forward to seeing you soon. Thanks.